Muted.
We really appreciate it. And as we talked about, I'm sure you'll anticipate, we're just going to talk about the election and really not, what happened, but kind of its impact on our money, on the markets and, stocks and bonds, and kind of what's happened and where things might go from here, and what we're thinking about in terms of managing people's assets. So just a quick look back at the days before the election. The expectation, I feel pretty comfortable in saying this, was fairly prevalent among investors that Donald Trump victory would result in a very large decline in the stock market. The number that seems to pop into my mind was 10%. Just do an initial write-off of 10% of the market, and then we'll go from there. And that in that scenario of a Trump victory, that bonds and gold were the place to be, and maybe gold under your mattress. I'm not sure exactly. So what has actually happened and continues to actually happen even today, stock market actually rose and continues to set record highs, although to be honest, the overall gain since the election, not that huge, but still 3% in 2 weeks is significant. And those same places that were supposed to be the safe havens, bonds and gold, have both fallen. So quite a surprise. And it seems like the stock market really virtually immediately adopted the view that the Trump combination of tax cuts, massive spending, large deficits, deregulation would prove effective at expanding profits, growing the economy. So in the category of things either overlooked, deemed less important, or dismissed as unlikely to happen, include possible severe restrictions on trade, as well as the impingement on corporate profits and flexibility that were part of the Trump platform. Now, some of the market moves have been, at least to our mind, readily explainable. Sectors doing particularly well include pharmaceuticals. Recall Hillary Clinton had a big focus on drug prices. The financial stocks have also done very well with a combination of rising interest rates, plus I'm going to call it a virtual certainty that regulation will be relaxed. And other sectors sort of very obvious, such as infrastructure and defense. And sectors that have done poorly encompass those that were most dependent on low interest rates, things like utility stocks and the real estate investment trust, the REITs. And also, as I mentioned right at the top, the bond prices have also fallen fairly significantly in a short period of time. But we have to really keep in mind that a significant decline in bond prices, it's still relatively small compared to what happens to stocks when they have a significant decline in a bear market. So this is basically what was expected to have happened, and then what actually has transpired over the past couple of weeks. But it's really probably on most of our minds, and what's important as we sit here today is where we go from here. What will happen with our asset classes? And as I try to wrestle with that and to think about that in a logical way and how specific asset classes might fare going forward, the way I kind of have developed, not my own framework, but the framework that I use to think about it is based on quadrants, if you will. So quadrants meaning there's 4 possibilities. And I really have found this a really handy way to think about the factors that most affect us as investors, with 2 factors being growth and inflation. And those 2 variables, growth and inflation, can be combined into 4 possibilities, and that's where I come up with the quadrants. And my little visual of it is if you draw inflation on an x-axis, growth on the y, it divides into 4 possibilities. And I just wanted to quickly just run through what those 4 are, and then we can kind of see, well, where might we end up, and that kind of tells us, well, what should we be thinking about from the investment point of view. So just for simplicity purpose, I just call quadrant number 1 weak economic growth and deflation, which maybe another way of calling deflation, maybe we just say lack of inflation. But, low prices, weak economic growth, that's quadrant one, that's bad. That's the Depression, that's even the economy in 2008. So that is one quadrant that can possibly happen. Quadrant number two, I've got it, that is weak economic growth, but with inflation. And that one, for those of us who remember the 1970s, that had a special name called stagflation. And for those who were investing in the 1970s, they would recall that was a dreadful period. So weak economic growth combined with inflation, we don't like that. A third quadrant would be strong economic growth with inflation. And honestly, that we haven't had this for a while. We might almost have to look back to the 1960s for that one. And there are various assets that perform well in that scenario. And the fourth quadrant, which might be the best of all, really, would be a strong economic growth and deflation / lack of inflation. That is the ideal place to be, really, as for an investor. And that has been basically the prevalent situation for most of the past 30 years. And that has been a superb period overall for financial assets. As to why that's happened, in many factors, we've got China's rise, low imports, and low import prices, combined with technology and automation, have just have really helped keep down a lot of costs. Organizations like Walmart, Amazon, those just didn't exist in the past. And they've really helped usher in this period of low inflation and pretty consistent economic growth and pretty remarkable returns for investors. So those are kind of the four areas. And again, just trying to think about where we might be heading to, into which quadrant. And the first thing that it does seem to us is that we are leaving this period of deflation and that we are entering a period of inflation, and we'll be in one of those inflationary quadrants. And of course the question is which quadrant, because it's very important which one. So will it be growth or stagnation? And even before that, why are we now saying that we might be expecting inflation now? And as I was getting ready for this call, I actually remembered sitting in Mary Malguar's office a decade ago doing one of these calls saying, I just don't see any inflation. And I really don't even see any potential for it, and I've been actually saying it pretty much ever since. So why the change? And I really do think that the election has really ushered in a real regime shift, and that we will be seeing massive government spending, tax cuts, a commitment to raising employment, a commitment to raising wages, the potentials to restrict trade, which hurts efficiency, which helps efficiency helps keep prices down. We seem to be moving to removing or impeding the flow of less expensive labor, impediments to corporate flexibility, just a more nationalistic approach to economic policies, which produces its winners, it produces its losers, no doubt about that. But one outcome does seem very likely to be inflation. So we do think we'll be in an inflationary quadrant, an inflationary environment. And we look around and saying, well, where do we think we will actually end up being? And the stock market has been telling us, I guess, over these past couple of weeks, that it's going to be the strong growth in inflation category, almost trying to predict an inflationary boom, as all the positive factors that I laid out early in the call seem to be outweighing any potential negatives. And the bond market, where the interest rates have risen pretty sharply, they're also saying, well, we're going to have inflation. Maybe they're not as convinced, and many bond investors are just waiting for the Fed to tell them what's going to happen. And that'll be happening, I guess, in a few weeks and ongoing. So then the question, I guess, becomes, well, what can we as investors and here at the family firm do in this environment of where maybe we're not 100% sure what's going to happen with the economy, but we are very fearful or expectant of inflation? So the most obvious is just to be very conservative on the bond side, with maturity short, a lot of inflation protection where we can pick it up. Because just remember, deflation is good for bonds, inflation is bad. The most simplistic relationship there is when we're thinking about bonds. So as we manage these portfolios and think about the portfolios, we just recognize we need inflation protection. So if there are bonds that can protect against inflation, that's great. Equities can help as well, especially for companies and industries that can find pricing power and to be able to adjust their prices. So just to kind of summarize all this, we do think inflation is likely. The stock market seems convinced that this will be accompanied by high growth and extraordinary profitability. That's great, and I wish we could all be, I wish I could be that giddily optimistic, but we just have to admit there's certainly a significant risk of the weak growth combined with inflation, the stagflation that we referred to with a shudder, and the biggest risks of that just being some sort of geopolitical conflict caused or exacerbated by trade frictions. And certainly if this situation started to develop, the strategy would definitely want to become more conservative, probably with both bonds and equities, and things like yield and interest rates and dividends, and they would really take center stage. So perhaps all of this is not giddily optimistic, but I would be remiss not to share just at least what we consider two pretty encouraging developments that really honestly just came out in the news. I read them an hour ago, but maybe last night. So as Donald Trump prepared a video talking about what his plans were for the first 100 days, he mentioned quite a few things, and there were two things that he did not mention, one of which was reopening or scrapping the NAFTA treaty with Mexico and Canada. Those who may recall, that was basically the centerpiece of his campaign. It would be an economic disaster if that happened. So it does not appear that that is on the agenda for the first 100 days. Another thing that had been promised to happen on day one that has now disappeared from the agenda is to declare China a currency manipulator, which would result in 40% tariffs being applied to their exports to us. Both of those were very key planks of his campaign, and I'm happy to see them not there right now, and we can just hope that they never see the light of day. So with that, thank you all for listening to that. I'd be thrilled to hear any questions, thoughts, comments that you all have, or things that are on your mind, and we'll all do our best to figure things out together.
Hey, Nate, this is Scott Flick.
Hi.
How are you?
Hi, Scott.
What are the early signs you would look for in this area of stagflation? You talked about potential precipitating events like conflict in the world combined with trade barriers, but in terms of metrics, are there things that you would start to watch for and see which direction they're moving to see if that's where we're headed?
Yeah, well, thanks, Scott. That's a great question. We actually will be able to see some things early next year, I believe, because one of the things that will be happening is that we've already seen the interest rates go up, which will make credit cards more expensive, mortgages more expensive, all the kind of things that depend on current interest rates. They will all become more expensive and will constrict the economy. All this happening before any kind of infrastructure projects can get underway. they always talk about the shovel-ready projects. That was something from 2009, and we don't even have a shovel yet for any of these things. So it's going to be a pretty lengthy delay between the stimulus and what is already happening in the financial markets. And it could very well be that there is a slowdown early next year, and that the road building projects and things like that end up being ineffective at addressing that slowdown from the inflationary conditions. So I probably did a bad job of explaining it, but I'm just saying there could be a mismatch in the timing between when the interest rates go up and when the actual economic help comes. And that would be, I'm sure that would be worrisome, because they just have to try to think of how to find a way to reduce the interest rates, or to find a way to take some measures that would improve the economy more quickly than repaving the roads would do.
Nate,
Hi. I couldn't tell if someone was about to ask a question and they got cut off. Or...
Hey, Ned,
Hi.
this is Alfonso here. How are you?
Hi, Alfonso.
I just have a quick question for you in terms of the portfolio split between bonds and shares. Is there anything that you would recommend at this point, or just stay as we are?
Well, I think I'm probably going to end up recommending that we stay as we are for almost everyone, especially if it looks like the economies will be fine, which it certainly seems like it will be. But, we'll just keep our eye on it. But I think, the biggest shift will just be within the bonds to kind of really deviate from the traditional bond index, which would have us buying a lot of traditional treasury bonds and things like that. And they're just trying to be smarter about it, and to, utilizing the bonds still as a stabilizing force, but also to provide some protection against inflation, which, the traditional bond market index does not do. And then within the equities, of course, we want to be, oh, I'm sorry.
Would you say then that it might be wise to decrease the share of bonds in the portfolio?
Well, yes, but maybe the answer is cash or CDs when they become a more feasible option, which it seems like they might in a couple of years. I always say I really miss the days when we could buy even just 4 or 5% CDs, and maybe we might not like how we get from where we are today to that point, but maybe when we do get to the point where the interest rates are a bit higher, that maybe instead of having the bonds that can move around in price, maybe CDs and things like that would become more of a viable option in our portfolios. And I, for one, will be thrilled when that happens. But we're still at 0 or 0.25%, or sometimes maybe get 1% on the CD, and they just don't make any sense yet.
Okay. Thanks.
Thanks, Alfonso.
Nate, I hate to ask the question, but it's an appropriate question whenever someone such as yourself is key to direction that we're going. Do you have a backup if you could wander a bus?
Well, there are people who could step in. There's a couple of colleagues that have they did do investments. We have a woman here who worked with investments at Charles Schwab. the people who would be leading the firm should I die know how to find a replacement, because I've talked about that with them. And that is something, Rick, that I do have on my plate, is something to to find someone who can be my colleague, step into my shoes. But obviously, I have been very careful about finding that person. But I do anticipate, getting some more depth of personnel here at the firm. But for now, there would be short-term solutions that certainly could get us through a year, in which time I'm very confident that Kate and the other leadership at the firm would be able to find a suitable replacement. As unique as I am, there's 100 other people that can do it as well. I do appreciate that, Rick.
Stay away from the buses.
And Metro too, if you.
Hey, Nate and Steve, it's Ed on the phone. May you long live and prosper, Nate, but I had a question for you. It's a bit of a parlor game, perhaps, but as we head into the end of the year, are there any sort of broad elements of consensus from what a tax reform package would look like, especially as it would affect individual investors, that might inform some year-end tax planning strategies, or looking into the future, any sort of broad consensus elements that you would identify as things to watch for 2017 in terms of individual tax impacts?
Sure. Well, that's a great question, and I do, again, this is, admittedly, things can always go wrong, especially when you start thinking about Congress, and, there's 535 or whatever people that want to be president sitting in Congress, certainly 100 senators. It does seem that that tax rate, just for individuals, when I think about individual tax planning, will probably be coming down for the highest levels of income. I do feel pretty confident about that for 2017. So for those of us who are, high earners, who have high income, a lot of the strategizing, I guess, we'll be thinking about taking deductions this year when possible, making charitable deductions this year, and perhaps if there's any way to delay income until 2017 or beyond, that would probably be advisable. Admittedly, with any kind of tax planning, when no legislation has even been suggested yet, that's a little risky, I guess, but it does seem, based on what Paul Ryan wants to do, what Trump has suggested that we want to do, there would be a reduction in the marginal tax rates, especially for the highest earners, where the declines could come from nearly 40% to 33%, and then actually the 40% is higher for those subject to the Affordable Care Act surcharges and that thing, and that could possibly go away as well, given that that is designated for repeal, I guess. So I guess that would basically be it. If you think that the tax rates on marginal income at the highest levels are in 2016 as high as they are likely to be, and again, to the extent you could, you would probably try to push more income into 2017 and to take what deductions you could in 2016. I don't know if you... Okay. Steve's nodding at me. I didn't say anything too dumb. So
yep, thanks. That's consistent with what I've been reading about. Thank you.
Thanks, Ed. Well, this has been fabulous. Thank you, everyone. Just to let you all know that we're recording the call. We'll put it on the website. We'll email out the link to everybody. We're also trying to do a better job of being proactive in communicating with you all. There is a family firm Facebook page, a family firm LinkedIn page, and we're going to try to incorporate those more into the website as well, and just share more of what's, what we're thinking about, what we're seeing of interest in more of a real-time manner without, we never want to get into the situation where we're sending you all the market recap every day because, we don't think that's important and you can get that somewhere else. But, when there are things that we think are important that we want to share with you, we're just looking for the best ways to do that. So we will, admittedly, it's trial and hopefully not too many errors, but we will definitely, as we always do, love your feedback on how we can communicate better. And we look forward to, many more communications like this where we can talk on days where the stock market is at a record high. That always makes it a little nicer.
Hey, thanks for stepping into the breach.
Thanks a lot, Rick. And I wish all of our clients and everyone on the call just a great Thanksgiving, and we'll talk to you all soon.
Likewise. Thank you, Nate.
Same to you, Nate.
Thank you.
Thanks, Nate.
Bye. Thanks.
Thanks a bunch.
Thank you.